Hello everyone, myself CA Yash Parmar, and it is my pleasure to be here today. At the outset, I would like to congratulate CTC on its centenary year and my best wishes to them. The topic on which I am going to deliberate has become absolutely critical in today's GST environment. The importance of conducting Know Your Vendor or KYV exercise and the safeguards that every taxpayer must adopt. You see, the GST regime is fundamentally built on trust, a self assessment system where the taxpayer is expected to be honest and compliant. But as we have all seen in the recent years, that trust is being closely monitored by technology. With the government's increasing use of data analytics and AI driven tools, there is now an unprecedented level of scrutiny on how input tax credit is being claimed and utilized. And that's exactly why the Know Your Vendor framework has emerged as a vital compliance shield, not just a best practice, but a business necessity. For years, the corporate world has focused on Know Your Customer or KYC, as we all know. This is especially followed in the banking and financial sector services. But under GST, we have entered a new era, one that demands Know Your Vendor. Because your vendor's compliance or non-compliance directly impacts your eligibility to claim input tax credit. If your vendor defaults, you could end up paying the price even when you have done everything right. So first, we need to discuss why the KYV matters, Know Your Vendor as we call it. What are the legal and financial risks? Let's start by understanding the legal foundation. Under Section 16(2) of the CGST Act 2017, there are specific conditions for availing input tax credit. What are these conditions? First, you must have a valid tax invoice, you must have received the goods or services, and here's the most critical one. Under Section 16(2)(c), the tax charged by your vendor must have been actually paid to the government. Now imagine this scenario. You have received the goods, paid your vendor in full, including the GST amount, but the vendor never deposits that GST with the government. What happens then? Your ITC is denied. This is called one-way filing, where the vendor files GSTR 1 but doesn't pay tax through GSTR 3B. And in such cases, genuine recipients often find themselves facing ITC reversals, interest, and penalty. The consequences are not just financial. They can trigger departmental scrutiny, audits under Section 65, special audits under Section 66, and in serious cases, even inspection and search proceedings under Section 67. The harsh reality is that department often shifts the burden of proof onto the recipient. They expect you, the taxpayer, to prove that your transaction was genuine and the goods or services were actually received by you. Now, what is the judicial standpoint over here in this particular issue? The judiciary has also echoed this approach. Courts have repeatedly held that merely producing invoices or bank payment proofs is not enough. You must demonstrate the actual movement of goods through e-way bills, transport receipts, or freight payment records. And if it's a service, you must show evidence of delivery, such as work reports, emails, or correspondence confirming the service. In short, it's not just about showing you made a payment. It's about showing that your transaction was bona fide, genuine, supported by evidence, and entered into with a reasonable care. Now, how to implement KYV in our organizations? It starts right from the onboarding stage, before you even place your first order with your vendor. Step 1. Verify the vendor's GST and check their status on the GST portal, whether active, cancelled, or composition dealer, etc. etc. And also check for retrospective cancellations. Step 2. Review their filing patterns, especially GSTR 1 and GSTR 3B. Any irregularity should raise a red flag. Step 3. Collect essential KYC documents like PAN or Aadhaar in case of proprietors or partners vendors, and a declaration of their compliance and turnover certificate, particularly about e-invoicing applicability. Today, with so many digital tools which are available, these verifications can be automated and periodically tracked. But onboarding is just the beginning. A robust KYV process requires continuous monitoring through the business relationship. Make it a practice to reconcile your purchase register with GSTR2B every month. Anyways, this is a mandatory requirement under section 16(2)AA for claiming the ITC now. This ensures that what you have claimed as ITC matches what your vendors have actually reported. You can also adopt a payment control mechanism whereby you can hold back the GST component of your vendor payment until the invoices reflect in your GSTR2B. This one step can save you from future ITC reversals. And finally, always document proof of receipt for goods. Maintain transporters' receipts, e-way bills, and delivery acknowledgements. For services, keep signed contracts, reports, and email communications. Always remember that documentation is your first and best defense. Now let's talk about safeguards, both preventive and defensive. The first line of defense is contractual protection. Every agreement with your vendor should include an indemnity clause which clearly states that if the vendor fails to pay tax to the government and if your ITC gets denied, then the vendor will compensate you for the ITC loss along with any interest or penalty. Second, always document your due diligence process. This record demonstrates that you acted in good faith with reasonable care, and courts have recognized that the recipient cannot be expected to ensure that the vendor has paid tax as long as due diligence is properly documented. If you ever face litigation or a show cause notice, certain procedural rights are very important. 1. Make sure you maintain a complete defense file containing all your invoices, copies of invoices, payment proofs, delivery documents, and supplier correspondences. 2. Assert your right to cross-examine any third party whose statements the department relies on. If you are denied that opportunity, such evidence may be rendered inadmissible. And 3. Check whether the notice or summons includes a document identification number, DIN as we call it. A notice which is issued without a DIN may not be legally valid. This procedural checks can make a big difference in defending your case. To conclude, the concept of know your vendor is not merely another compliance requirement. It is a strategic safeguard for your financial health and business reputation. A well-implemented KYV framework ensures that you are not blindsided by a vendor's default. It helps you maintain clean records, defend your ITC claims, and project a strong compliance culture. In the complex and interconnected GST ecosystem, proactive monitoring, meticulous documentation, and timely action are your best defenses. Let us remember, the objective of law is not to penalize the honest taxpayers, but to ensure that fraudsters do not take advantage of the system. So let's stay alert, stay compliant, and make sure that the burden of tax evasion falls on the fraudulent and not on the genuine. Thank you so much, and stay tuned for more in the series.